A new survey came out this week studying ETF investors who use Charles Schwab's platform. It revealed a lot about who is using ETFs. Joining me is Eric Balchunas. He's Bloomberg Intelligence Senior ETF Analyst. So two things that you noticed in the survey you say are indicative of a bright future for ETFs. What are those two things?
Yeah, well, first of all, people who use Schwab are typically early adopters, self-directed types, fairly wealthy. So what happens here is probably going to sprinkle down to the rest of retail ultimately. So that's why this is a good group to look at. Two numbers stuck out. One is that you see that ETFs as the primary investment jumped from 37% to 42%. That's a huge jump in only a year. That means they're repeat customers. That's always a good sign. And then you can see that jump there. People are using them, having a good experience, and then coming back. They also are majority long-term investors. That means they feel comfortable putting their nest egg in ETFs. You also saw millennial investors are by far the biggest generation using the ETFs. And as you get older, the less likely you are to use them. So the younger you are, the more likely you are to use ETFs. And that's obviously a good sign because millennials don't have a ton of money now, but they're going to get richer. They're going to inherit a lot of money from the boomers who are probably going to cash out those mutual funds. So that to me is a big, two rising tides.
And just quickly, when it's going to a 40-something% from a 30-something%, what is it replacing? What are the ETFs as investments replacing in the portfolio?
Mutual funds, single securities, well, those two for them. No derivatives, probably.
Gotcha, yeah. So that's what encourages you in this report about the future of ETFs. Is there anything that worries you? Basically,
your last question. There was a stat in there that said 50% of people said they would likely use an ETF in place of a single security. This worries me. Look, ETFs replacing mutual funds, that's fine. They could do that all day long, or derivatives. But if ETFs take too much action away from the things they hold, it's going to creep up costs of trading ETFs and ultimately could make it harder in one of those bad days. You don't want ETFs to be too much of the percent of the volume of trading every day. Right now, they're about 30%. I don't want to see them steal too much liquidity and assets from single securities.
I mean, presumably it would then affect sort of direction of the, I mean, if it's all going in one direction because it's an ETF holding that holds an enormous amount versus individuals, then you would think that...
Yeah, put it this way. ETFs need the underlying securities to be liquid and have a healthy market.
Right.
That's how they're so good. If they vampire too much liquidity away from them, that could be a problem.
Interesting.